This video provides an overview of the major concepts covered in Chapter 23, Mutual Fund Operations. A mutual fund is an investment company that sells shares and uses the proceeds to manage a portfolio of securities. Mutual funds have grown substantially in recent years, and they serve as major suppliers of funds in financial markets. Chapter 23 includes 6 key learning objectives. First, to provide background information on mutual funds. Second, to describe the various types of stock and bond mutual funds. Third, to describe key characteristics of money market funds. Fourth, to discuss key characteristics of hedge funds. Fifth, to describe other types of funds. And sixth, to describe the valuation and performance of mutual funds. Let's begin with some background on mutual funds. Mutual funds serve as a key financial intermediary as summarized in this exhibit. They sell shares to individual investors and invest the money they receive in a portfolio of securities for the investors. They accommodate financing needs of corporations by purchasing newly issued stocks and corporate bonds in the primary market. They also accommodate the financing needs of the U.S. Treasury and municipal governments by purchasing newly issued Treasury bonds and municipal bonds in the primary market. Mutual funds also frequently purchase securities in the secondary market, thereby making the securities markets more liquid. The price per share of a mutual fund is equal to the net asset value per share, which represents the value of the portfolio per share after accounting for expenses incurred for managing the fund. Consider a quick example where Newark Mutual Fund has 20 million shares issued to its investors. It uses the proceeds to buy the stocks of 55 different firms with a combined total market value today of $500,005,000, to which we add interest and dividends of $10,000 and subtract fund expenses of $15,000 to end up with a total market fund value of $500 million. If we divide that market value by the 20 million shares issued, that works out to a net asset value of $25 per share. Mutual funds can generate returns to their shareholders in 3 ways. First, they can pass on any earned income from dividends or coupon payments as dividend payments to the shareholders. Second, they can distribute the capital gains resulting from the sale of securities within the fund. A third type of return to shareholders is through mutual fund price share appreciation. As the market value of a fund's security holdings increases, the fund's NAV increases, and the shareholders ultimately benefit when they sell their mutual fund shares. Mutual funds must adhere to a variety of federal regulations, and all such funds must register with the Securities and Exchange Commission. Mutual funds are also regulated by state laws, many of which attempt to ensure that investors fully understand the risks. Mutual funds are required to provide potential investors with a prospectus that contains information about their objectives, management, and risk. Prospectus disclosures include the minimum investment required from investors, the investment objective of the fund, the return on the fund over past years in comparison to a broad market index, the exposure of the mutual fund to various types of risk, the services offered by the mutual fund, fees incurred by the fund such as management fees that are passed on to the investors, and the names of the portfolio managers and length of time that they've been employed by the fund in that position. Each mutual fund is managed by one or more portfolio managers who must focus on achieving the stated investment objective of that fund. These managers prefer liquid securities that can be easily sold in the secondary market at any time. Portfolio managers may also maintain a small amount of cash for liquidity purposes. Mutual funds interact with other financial institutions as illustrated in this exhibit. Mutual funds sometimes purchase stocks or bonds newly issued by financial institutions, and in this way, they partially finance the expansion of those institutions. Some mutual funds are owned by commercial banks, in which case bank customers can switch their savings between bank deposits and mutual funds. Each type of mutual fund uses one or more financial markets to manage its portfolio as shown in this exhibit. Because mutual funds focus on investing in securities, they frequently participate in the securities market. They also participate in the futures and options markets to hedge against interest rate risk or the risk of adverse stock market conditions. In addition, some mutual funds take speculative positions in futures or options contracts. Mutual funds pass on their expenses to their shareholders. Expenses can include compensation to the portfolio managers and other employees, research support, and other fees. Expenses can be compared among mutual funds by measuring the expense ratio, which is equal to the annual expenses per share divided by the fund's NAV. Many mutual funds have an expense ratio between 0.6 and 1.5%. A high expense ratio can have a major impact on the returns generated by a fund for its shareholders over time. This exhibit provides a comparison of two mutual funds, each of which generates a return on its portfolio of 9.2% per year, ignoring expenses. One mutual fund has an expense ratio of 3.2%, so its actual return to shareholders is 6% per year. The other mutual fund has an expense ratio of 0.2%, so its actual return to shareholders is 9% per year. Assuming you invest $10,000, after 5 years, the value of the mutual fund with the low expense ratio is approximately 20% higher than the value of the mutual fund with the high expense ratio. After 10 years, its value is nearly 40% more. After 20 years, its value is 87% more. Mutual funds may be either load funds or no-load funds. Load funds are promoted by registered representatives of brokerage firms who earn a sales commission generally ranging between 3 and 5.75% when someone invests in the fund. This is commonly referred to as a front-end load. Some mutual funds have a back-end load, also known as a rear load or reverse load, which is the withdrawal fee charged when the investor withdraws the money from the mutual fund. Back-end loads often range between 5 and 6% for the first year, but then decline by a certain percentage each subsequent year. No-load funds are promoted strictly by the mutual fund of concern, thereby avoiding any intermediary. Most investors who feel capable of making their own investment decisions prefer to invest in no-load funds. Some mutual funds charge investors a 12B1 fee as part of the fund's annual expenses to cover administrative or marketing expenses. Mutual funds, like corporations, are subject to some form of governance that are intended to ensure that the managers serve the shareholders' interests. Mutual funds also have a compliance officer who's supposed to ensure that the fund's operations remain in line with its objective and guidelines. Because mutual funds invest large amounts of money in some stocks, they become major shareholders of firms. Portfolio managers of mutual funds that have a large investment in stocks commonly serve on the board of directors of various firms. Mutual funds are typically classified as either stock or equity mutual funds, bond funds, or money market funds, depending on the type of securities in which they invest. As this exhibit shows, based on the market value of assets, stock mutual funds are dominant. Now let's take a closer look at stock and bond mutual funds. There are 7 common types of stock mutual funds. For investors who desire a high return and are willing to accept a moderate degree of risk, growth funds are appropriate. These funds are typically composed of stocks of companies that are expected to grow at a higher than average rate in the future. The primary objective of a growth fund is to achieve an increase in the value of stocks. Also known as aggressive growth funds, capital appreciation funds are composed of stocks that have potential for very high growth but may also be unproven. These funds are suited to investors who are willing to risk a possible loss of value. Some investors are looking for potential for capital appreciation along with some stability in income. For these investors, a growth and income fund, which contains a unique combination of growth stocks, high dividend stocks, and fixed income bonds, may be most appropriate. In recent years, awareness of foreign securities has been increasing. Investors historically avoided foreign securities because of the high information and transaction costs associated with purchasing them and monitoring their performance. International mutual funds were created to enable investors to invest in foreign securities without incurring these excessive costs. Some mutual funds, called specialty funds, focus on a group of companies sharing a particular characteristic. For example, industry-specific funds may concentrate on energy, banking, and high-tech stocks. Some mutual funds are designed to simply match the performance of an existing stock index. For example, Vanguard offers an index fund that's designed to match the S&P 500 index. Index funds are composed of stocks that, in aggregate, are expected to move in line with the specific index. A multi-fund mutual fund invests in a portfolio of different mutual funds. It achieves even more diversification than a typical mutual fund because it contains several mutual funds. However, investors incur 2 types of management expenses: the expenses of managing each individual mutual fund and the expenses of managing the multi-fund mutual fund. And for this reason, the expense ratio of a multi-fund fund can be relatively high. Bond mutual funds fall into 5 general categories. Income funds are appropriate for investors who are mainly concerned with stability of income rather than capital appreciation. Mutual funds containing municipal bonds allow investors in high tax brackets to avoid taxes while maintaining a low degree of credit risk. Investors desiring high returns and willing to incur high risk may consider investing in bond portfolios in which at least 2/3 of the bonds are rated below Baa by Moody's or BBB by Standard & Poor's. These portfolios are referred to as high-yield funds or junk bond funds. International bond funds contain bonds issued by corporations or governments based in other countries. Global bond funds differ from international bond funds in that they contain U.S. as well as foreign bonds and may be more appropriate for investors who want a fund that includes U.S. bonds within a diversified portfolio, whereas investors in international bond funds may already have a sufficient investment in U.S. bonds and prefer a fund that focuses entirely on foreign bonds. Each type of bond fund may be further segmented according to whether it focuses on long-term bonds with 15 to 30-year maturities or intermediate bonds with 5 to 10-year maturities. Long-term bond funds usually have a higher yield to maturity, but their values are more sensitive to interest rate movements than bonds in intermediate-term funds. Hybrid funds are another category of mutual funds and include both stocks and bonds and sometimes other types of assets as well. Asset allocation funds contain a variety of investments which is adjusted by the portfolio managers in response to expectations. For example, a given asset allocation fund will tend to concentrate more heavily on bonds if interest rates are expected to decline, whereas it'll focus on stocks if a strong stock market is expected. Target date funds, also known as life cycle or age-based funds, are designed to automatically change the proportions of stocks and bonds as the investor ages. After the credit crisis of 2008 to 2009, a number of investors looked for mutual funds that might shield them from extreme market volatility. These funds use more complex trading strategies than other mutual funds, and they hold non-traditional assets such as global real estate, derivative securities, and commodities. The next learning objective in the chapter relates to money market funds. Money market mutual funds, sometimes called money market funds or MMFs, sell shares to investors and use the proceeds to invest in short-term money market instruments for their investors. This exhibit shows the composition of money market fund assets in aggregate. Commercial paper, CDs, and repurchase agreements are the most widely held components. Money market funds are generally perceived to be very safe. They have a low level of credit risk because the money market securities in which they invest have low credit risk. Because they invest in instruments with short-term maturities, their market values are not overly sensitive to movements in market interest rates. Therefore, their exposure to interest rate risk is low. In general, MMFs are normally characterized as having relatively low risk and low expected returns. The role of MMF portfolio managers is to maintain an asset portfolio that satisfies the underlying objective of the fund. If the managers expect a stronger economy, they may replace maturing risk-free securities, such as T-bills, with more commercial paper or CDs. The fourth key concept in the chapter relates to hedge funds. Hedge funds sell shares to wealthy investors and financial institutions and use the proceeds to invest in securities. Hedge funds differ substantially from mutual funds in a number of ways. They often require very large investments, such as $1 million or more. They're not open in the sense that they may not always accept additional investments or accommodate redemption requests unless advance notice is provided. Hedge funds may stipulate that investors can't make withdrawals or redemptions for several years after their initial investment. Hedge funds are also subject to minimal regulation, and they invest in a wide variety of investments to achieve high returns. Thus, unlike mutual funds, they're not restricted in terms of the types of investments they wish to pursue. Hedge funds commonly use borrowed funds to complement the equity that they receive and invest. This use of financial leverage allows them to make even more investments with a given amount of equity and can magnify the returns. For example, Durham Hedge Fund uses $3 of borrowed funds for every $1 of equity that it invests. Therefore, it can obtain $4 of assets for each $1 of equity that it invests. If its investment results in a positive 20% return on assets, or ROA, this represents a return on equity, or ROE, on the investment of 80%. The financial leverage in this example allows the hedge fund to magnify its returns to investors by 4 times the return on assets. Of course, financial leverage can also magnify negative returns or losses, so it increases the risk to investors. Let's take the same example and assume now that its investment results in a negative 20% return on the assets. This represents a return on equity of negative 80%. Hedge funds charge a management fee of between 1 and 2% of the investment per year. In addition, they charge an incentive fee that's based on the return of the fund. Hedge funds commonly attempt to pursue an information advantage that allows them to make good investments. Hedge funds often hire experts with experience in a particular industry to serve as consultants and offer insight about the industry or specific firms within that industry. A common strategy used by hedge funds is to take a very large short position in stocks that they believe are overvalued. During the credit crisis of 2008 and 2009, hedge funds were accused of making market conditions worse by taking short positions in some of the financial institutions that held subprime mortgages or other mortgage-related securities. Bernie Madoff managed a large and well-respected hedge fund that included various institutions, charities, and wealthy individuals among its investors, and the fund reportedly earned favorable returns every year. When some investors wanted to cash out their investments in December 2008, there was no money available for them. Madoff admitted that he had periodically used money from investors to pay off investors who wanted to cash out of the fund. The potential losses to investors were estimated to be as high as $50 billion, making this possibly the largest financial scandal in U.S. history. In July 2010, the Financial Reform Act was enacted, and it contained many provisions that were designed to stabilize the financial system. Now let's discuss other types of funds. Closed-end funds issue shares and use the proceeds to make investments in stocks or bonds representing a particular sector or country on behalf of their investors. Unlike open-end mutual funds, closed-end funds are closed to new investors after the initial offering of shares. In addition, they don't repurchase or redeem the shares they sold. Investors who purchase shares of closed-end funds can sell the shares on a stock exchange in the secondary market, and new investors can purchase the shares on the stock exchange. The market price of a closed-end fund can deviate from the aggregate value of the underlying stocks, measured by the net asset value per share. For some closed-end funds, the shares are priced higher than the aggregate value of the respective portfolio. Exchange-traded funds, or ETFs, are designed to mimic particular stock indexes and are traded on a stock exchange just like stocks. Because ETFs are intended to mimic a particular index, they differ from most open and closed-ended funds in that they're not actively managed. Because ETFs are not actively managed, they usually don't have capital gains and losses that must be distributed to shareholders. ETFs are more liquid than shares of open-ended mutual funds because they can be sold at any moment during trading hours, whereas mutual funds are sold at the end of the day. Like closed-end funds, ETFs can be sold short. In fact, investors more commonly short sell ETFs than closed-end funds because the ETFs are more liquid, making it easier to execute the short sales. ETFs are commonly classified as broad-based, sector, or global, depending on the specific index that they mimic. Venture capital, or VC funds, use money that they receive from wealthy individuals and some institutional investors to invest in companies. They pool the money that's invested in the fund and use the proceeds to create a diversified equity portfolio. Unlike mutual funds, VC funds typically invest in privately held firms rather than publicly held firms, so their investments are not liquid. Venture capital funds tend to focus on tech firms, which have the potential for high returns but also exhibit a high level of risk. Private equity funds pool money provided by individual and institutional investors and buy a majority or entire stake in businesses. The market for private businesses is not as efficient as the market for publicly traded stocks. Information about private businesses is very limited, so private equity fund managers may see opportunities to buy undervalued businesses. A real estate investment trust, or REIT, is a closed-end fund that invests in commercial real estate or mortgages. Like other mutual funds, REITs allow small investors to participate with a low minimum investment and generate income for shareholders by passing through rents on real estate or interest payments on mortgages. Equity REITs are sometimes purchased to hedge against inflation, as rents and property values tend to rise with inflation. Because mortgage REITs essentially represent a fixed income portfolio, their market value will be influenced by interest rate movements. During the credit crisis in 2008 and 2009, many mortgages experienced late payments or defaults. Consequently, mortgage REITs experienced losses during that period. In particular, those REITs that invested heavily in subprime mortgages suffered severe losses. The last concept in the chapter relates to valuation and performance of mutual funds. Over a specified period, the change in valuation of a stock mutual fund can be modeled as a function of changes in the market conditions, MKT, sector conditions, sector, and management abilities, MANAB. A change in a stock's mutual fund valuation is usually closely related to a change in market conditions. In fact, some mutual funds or index funds attempt to resemble a particular stock market index. The valuation of a stock market fund focused on a specific sector is influenced by conditions in that sector. For example, the valuations of mutual funds that focus on U.S. technology stocks tend to rise substantially whenever the technology sector performs well. A mutual fund's performance may also be affected by the abilities of its managers. Mutual funds in the same sector can experience different changes in valuation because of differences in management abilities. Over a specified period, the change in the valuation of a mutual fund that invests in bonds can be modeled as a function of changes in the risk-free interest rate, RF, the risk premium, RP, and management abilities. The prices of bonds tend to be inversely related to changes in the risk-free interest rate. During periods when the risk-free rate declines substantially, the required rate of return by bondholders declines, and most bond funds perform well. The prices of bonds tend to decline in response to an increase in the risk premiums required by investors who purchase bonds. When economic conditions deteriorate, the risk premium required by bondholders usually increases, which results in a higher required rate of return and lower prices on risky bonds. The performance levels of bond mutual funds in a specific bond classification can vary because of differences in the abilities of the fund's portfolio managers. If the portfolio managers of one bond fund in that classification have superior skills in selecting undervalued bonds, that bond fund should generate higher returns. The performance of any given mutual fund may be primarily driven by a single economic factor. For example, the performance of growth stock funds may be highly dependent on the stock market's performance or market risk and interest rate movements or interest rate risk. The performance of any international mutual fund is influenced by the dollar's value, representing exchange rate risk. Many rating services rate mutual funds. Some ratings are based on past performance over a recent period, such as the last year or last 3 years. Mutual funds with high ratings based on past performance often attract large inflows of new investments. A variety of studies have been attempted to assess mutual fund performance over time. Measuring mutual fund performance solely by return is not a valid test because that return is likely to be highly dependent on the performance of the stock and bond markets during the period of concern. Most studies assessing mutual fund performance have found that mutual funds do not outperform benchmarks, especially when accounting for the types of securities in which each fund invests. Advocates of market efficiency suggest that, beyond insider information, market prices should already reflect any good or bad characteristics of each stock, making it difficult to construct a portfolio whose risk-adjusted returns will consistently outperform the market.